A retired nurse in Canada built a $750,000 tax-free savings account. That sounds like a dream, right? Decades of disciplined saving, smart investing, total tax-free growth. Except CRA didn't see it that way. They audited the account, reclassified a massive chunk of those gains as taxable income, and sent her a bill she absolutely was not expecting. So what went wrong? And how do you make sure the same thing doesn't happen to you? Welcome to True North Wealth. Today we're pulling apart one of the most talked about TFSA stories in recent Canadian tax history. Not to scare you off investing, but to show you exactly where the line is, why some people unknowingly cross it, and what a $750,000 TFSA actually looks like when CRA decides to take a closer look. By the end of this video, you'll understand how the CRA defines acceptable TFSA activity, what specific behaviors trigger an audit, and how you can build serious long-term wealth inside your TFSA without ever landing on their radar. Let's get into it. First, let's set the stage. The tax-free savings account was introduced in 2009 with a $5,000 annual contribution limit. Since then, that limit has been adjusted several times. It's been as high as $10,000 in 2015, and for 2024 it sits at $7,000. If you were 18 or older and a Canadian resident in 2009, your total lifetime TFSA contribution room, as of 2024, is $95,000. That's real money, but it's nowhere near $750,000. So how does someone end up with $750,000 in a TFSA? There are really two ways. The first is legitimate, extraordinary investment returns over a long period. If you contributed the maximum every year and invested in high-growth assets, compounding could theoretically push your balance well above your total contributions. We're talking about someone who got in early on the right stocks or ETFs, reinvested everything, and let time do its work. That happens. It's rare, but it happens. The second way, and this is where CRA gets interested, is if the account was used more like a business than a personal investment account. We're talking about frequent trading, generating what the CRA calls business income inside a tax-sheltered account. And that's exactly the category this nurse's account fell into. Her TFSA had grown dramatically, yes, but the way it grew is what triggered the audit. She wasn't just buying and holding index funds. The account showed a pattern of active, frequent trading that CRA concluded was a business activity. And under Canadian tax law, business income earned inside a TFSA is not tax-free. It's fully taxable. Now let's talk about this business income concept, because it's the core of what tripped up this case, and it's widely misunderstood. The CRA doesn't define a specific number of trades per year that makes you a business. There's no official threshold that says 10 trades and you're fine, 11 and you're not. Instead, they use a set of factors, sometimes called the badges of trade, to make a judgment call. Those factors include things like, how often are you trading? How long are you holding positions? Are you using leverage or margin? Do you have specialized knowledge of the securities you're trading? Is trading your primary source of income or a major activity in your life? And critically, is the way you're operating consistent with someone trying to profit from short-term price movements rather than long-term investment growth? In the nurse's case, CRA apparently found enough of these factors present to conclude that a significant portion of her TFSA activity crossed the line into business income territory. The result? That portion of her gains, potentially hundreds of thousands of dollars, became taxable, wiping out the core benefit of the account. Here's the number that really puts this in perspective. If $400,000 of her $750,000 balance was reclassified as business income, and she's in a higher tax bracket, say 43% combined federal and provincial, we're talking about a potential tax bill in the range of $172,000 on money she thought was completely protected. That's the kind of outcome that changes retirement plans overnight. So what actually puts you on CRA's radar in the first place? Let's be real, CRA isn't manually reviewing every TFSA in Canada. They use data, algorithms, and red flags to identify accounts that warrant a closer look. Here are the main triggers. Number 1. Account size relative to contribution room. If your TFSA shows a balance dramatically higher than your total allowable contributions, and we're talking multiples higher, not just a good year of returns, that's a flag. Financial institutions report TFSA balances to CRA and a $750,000 account when the lifetime contribution room is $95,000 is going to stand out. Number 2. Trading frequency reported by your brokerage. Your broker reports information to CRA. If your account shows hundreds of trades per year, especially short-duration trades, that pattern is visible. Number 3. Overcontribution penalties already assessed. If CRA has already had to contact you about exceeding your contribution room, you're already in their system as someone who needs monitoring. Number 4. Income inconsistency. If your reported employment or pension income is modest, but your TFSA has grown astronomically, CRA may question the source of funds and the nature of the investment activity. Number 5. Use of certain account features. Things like trading options, using leverage where it's available, or holding certain non-qualified investments can all attract additional scrutiny. Now, importantly, none of these factors alone means you're in trouble. Plenty of Canadians have very large TFSAs built through perfectly legitimate, long-term investing. But the combination of several of these factors, especially high trading frequency and outsized account growth, is what prompts a closer look. Alright, so how do you build a big TFSA the right way, without any of this risk? Because the goal here isn't to scare you out of using your TFSA aggressively. The goal is to help you use it smartly. The simplest, most defensible TFSA strategy is also historically one of the most effective: buy diversified, low-cost ETFs and hold them for the long term. A portfolio built around broad Canadian, US, and international equity ETFs, with low management expense ratios, ideally under 0.25%, held for decades, with dividends reinvested, has historically generated strong real returns. And because you're not trading actively, there's no business income argument to make. You're clearly an investor, not a trader. If you want to hold individual stocks, that's not automatically a problem. Buying and holding 10 to 20 quality companies for years at a time is still consistent with investment activity. The risk rises when you're buying and selling the same positions repeatedly, rotating frequently, and prioritizing short-term gains. One more thing worth mentioning: your TFSA isn't your only account. Coordinating your TFSA with your RRSP, your FHSA if you're eligible, and your non-registered accounts is where real tax optimization happens. High-growth assets belong in the TFSA. Interest-bearing or dividend-heavy assets might make more sense in the RRSP. And assets that generate capital gains, taxed at only 50% inclusion in Canada, can sometimes be fine in a non-registered account depending on your situation. The point is, the TFSA is a powerful tool. You don't need to trade like a hedge fund inside it to get rich. Time, consistent contributions, and reasonable asset allocation do the heavy lifting. Let's bring this together. A $750,000 TFSA is not inherently a problem, but how you got there matters enormously to CRA. If your account grew through frequent, active trading that looks more like running a trading business than investing for retirement, CRA has the authority to tax those gains as business income. The nurse in this story learned that the hard way. The key takeaways: understand your contribution room, $95,000 lifetime as of 2024, and never exceed it. Keep your investment activity consistent with a long-term investor mindset, not a day trader. If you do hold individual securities, document your rationale and hold periods. Coordinate your TFSA with your other registered accounts for maximum tax efficiency. And if you're unsure about your specific situation, talk to a qualified Canadian tax professional before CRA talks to you first. If this video opened your eyes to something you hadn't considered about your TFSA, do us a favor and share it with someone who needs to hear it. Drop a comment below. We read every one. And let us know, how are you currently investing inside your TFSA? Are you a buy and hold investor? Or do you trade more actively? We'd love to hear your approach. And if you want more videos on TFSA strategy, RRSP optimization, and Canadian tax planning that